Welcome back. With the ability to invest across a diverse range of assets, AIFs are perfectly poised to leverage the shifts in market dynamics, emerging sectors, and economic trends to deliver substantial returns. The upcoming panel aims to unravel the sophisticated strategies that AIFs unfold as we explore the avenues that promise not just growth but a redefinition of wealth creation. Remember, the future belongs to those who prepare for it today. The panelists are Mr. Nishad Khanolkar. Mr. Nishad is the president and fund manager at India Inflection Opportunity Fund. He is a chartered accountant and an associate member of CPA Australia. He has an experience of global fund management of 17 years, in addition to 5 years of corporate finance. Previously, he was the CEO of SP Growth Partners, an asset management company based out of Hong Kong. Currently, he has been associated with India Inflection Opportunity Fund, a CAT2 AIF managed by Pantomath Group. Post their success with the Series 1 fund, wherein they managed to raise the commitment of INR 500 crores, they have launched their next series of fund, Bharat Value Fund, a INR 1,000 crores mid-market pre-IPO J-curve opportunity fund. Our next panelist, Mr. Jaimin Gupta. Mr. Jaimin Gupta is the co-founder of Chanakya Fund. He is a young entrepreneur who has an kitty in various accolades, including Crown of Gujarat. He has a diverse set of business interests, ranging from being a finance wizard, an expert in SME exchange investment space, and currently is a promoter to Chanakya Opportunities Fund and Step Trade Revolution Fund under investment management company Step Trade Capital. Mr. Neil Behel. Mr. Neil is the founder and fund manager at Negen Capital. He has more than a decade's experience in the Indian capital market. He founded Negen Capital Situations PMS in April 2017, which has maintained its highest 5-star rating over the past 3 years and remained one of India's top performing PMS in the multi-cap category. Mr. Behel also writes a bi-weekly newsletter where he talks about special situation investing, emerging business trends, and startups. Mr. Yash Raval. Mr. Yash is the CEO, Fund Management at Wellspun One. Yash has 15 plus years of overall experience with 13 years in real estate investing and asset management, during which he worked on transactions of over USD 600 million. Prior to joining Wellspun One, Yash was principal at Proprium Capital Partners, an independent fund manager. Yash worked in Morgan Stanley real estate investing from 2007, where he was in investing and asset management roles, including leading and asset management efforts for MSREI's India portfolio. The session will be moderated by Ms. N. Mahalakshmi. Ms. N. Mahalakshmi, a financial journalist of 25 plus years, is an authoritative media voice. She is part of the senior leadership team at Network 18 and currently leads markets and economy coverage at Money Control. She was earlier the editor of Outlook Business and Outlook Profit magazines, and before that, the editor of Markets and Investing at Business Standard newspaper. Over to you, Ms. Mahalakshmi.
Thank you so much, Akriti. That was quite a nice introduction of all the panelists. And I'm obviously very delighted to be doing this panel. It's a special pleasure also because this is a absolutely wonderful emerging opportunity. And as much as I'm here to moderate this discussion, I'm also here to learn from the panelists what this opportunity is really about and how should we really look at this opportunity vis-a-vis the public collectives that all of us know about. And money is of course gushing in there, and this is an opportunity where the rich and more sophisticated investors are exploring and generously pouring money into and it should not be just the privy of the elite. And that's why I'm excited to do this panel. So let me just head to the panelists straight. First off, Nishad, I'll come to you. I want each one of you to just articulate your, what is the philosophy of your fund offering? What is the underlying strategy? Tell us a little bit, like quickly, in about 2 3 minutes, maybe 4 minutes. Articulate your fund. What does it offer? What is the risk reward profile and the underlying strategy? And then we will sort of delve a little deeper into whatever you have to say. Neil.
Thanks, Mahalakshmi, and thanks to Kamal Bhai and his entire team for first of all allowing me to be a panelist on this platform. So, Mahalakshmi, to answer your question, India Inflation Opportunity Fund is the fund managed by Pentomath Group, and under this fund, we basically target for the mid-market opportunities. So, companies which are likely to go for IPO in next 2 years to 3 years target, that is our hit catchment area. Under this fund, we partner with the growing enterprises which are underscored by the entrepreneurial zeal, and that translates into the J curve, yet sustainable wealth creation. What we look for is mid-market opportunities, established businesses, traditional industries, which are basically asset-backed industries, industries which supports the big industries who have got the PLI scheme, and what we believe in providing the growth capital. And the most important point I would like to mention over here is that in addition to the kind of due diligence and the financial network that we do, in our con score, the 30% or more than that weightage goes to the behavioral due diligence, because behavioral due diligence, in our opinion, matters a lot. So that is, so this fund is basically a market pre-IPO GECO opportunity. If I could explain in 2 minutes. And the first fund we have launched, India Inflation Opportunity Fund, a 500 crore fund, and second fund, Bharat Value Fund. We see no difference between the two funds, barring the size is doubled.
Sure. We'll talk about your strategy a little more, but before that, Jaimin, you want to come in on your strategy and your fund?
Thank you, Mahalakshmi, for having us, and also Kamal. So I'll start this way. So we started Chanakya Opportunities Fund a year back with a vision to cater to SME companies. So Chanakya is India's first SME exchange focused fund. So all the companies who are coming for an IPO on SME exchange, we invest in that companies that might be in anchor or in the secondary market. Secondly, we invest in SME companies on a pre-IPO stage. These two are our investment stages. It's a 100 CR plus 100 CR green shoe, 200 CR fund. And secondly, then it's a AIF CAT 2. So it was more focused on the primary market and pre-IPO market in the SME segment. Small SME companies are the growing and the next future blue chip companies of today. So we have a heavy vision, and we really think these companies could be the next blue chip companies of India. Basis on that, we have our investment theses and strategies, and we invest in these companies. Second fund we launched is the Step Trade Revolution Fund. It's a CAT 3 open-ended fund. So we are targeting a corpus of about 500 CR in next 1 year. This we would be investing in micro cap and small cap companies in secondary market, and somewhat of 20-30% in primary market through anchor or QIB portions. Least we would focus on pre-IPO. More we would focus on primary and secondary markets. Chanakya is completely about pre-IPO deals. So this is the basics of both the funds, and there is much more details about the investment strategy and thesis, which we can discuss later.
Sure. Neil, you want to come in next?
Yeah, sure. Hi, Mahalakshmi. Good evening. So we started with a PMS, which was, we saw that in the market, a lot of people are doing a similar kind of investing, and we always wanted to focus on value investing. But I realized, just like, you're not going to find good quality companies lying around at attractive valuation. So you got to work hard to do value investing. And I thought that, while in bear market it's very easy to do value investing, in bullish markets, it becomes more and more difficult. So we started with a concept called special situations. pure special situations investing, whereby we are looking at corporate restructurings as a way to figure out companies which get discarded while let's say there's a spin-off where there's a conglomerate and people are investing for the main business. And when a smaller entity gets spun out, the larger institutional investors, they don't have too much of an interest in the smaller non-core business. So many times post demerger, a lot of selling pressure comes. So we thought, this is a great way, a modern take on value investing. And the fund has done pretty well. The last 5 years, for example, the fund has done a CAGR of 33.74%. So we started with the PMS. Then we launched a Category 3 AIF. The idea was that while we are doing value investing in the capital market, there's one more avenue, which is around IPOs. We thought there was a pain point that a lot of these IPOs are, first of all, is a big opportunity. In bull markets, a lot of these IPOs open higher. And if you try to apply for these IPOs, you don't get any allocation. So a lot of these HNI investors who are largely our clients are very frustrated. They try, but they don't get any allocation. So I thought that, we can solve this pain point for our clients. And, we could open a Cat 3 AIF. Full job would be to get involved in pre-IPOs and get involved in anchor allocations with all the connects that we have. And we've been able to successfully do this both in main board and in the SME stock exchange. I think SME presents an opportunity. There are also a lot of questionable companies, but the opportunity is that it's largely ignored by the very big institutional investors. And while there are questionable companies in here, this doesn't call for ignoring the whole segment, it calls for extraordinary due diligence. So if someone can do a big amount of due diligence in a lot of these companies, there's big potential. Personally, I think there's a lot of potential opportunity in the SME segment. So yeah, the PMS is largely mid cap focused. The SME, the AIF that we have is largely small cap and SME stocks focused. In total, we are managing now north of 1,000 crores. And yeah, this is what we are doing.
Sure. Thank you so much. Neil, Yash, you want to come in?
Sure. Thanks, Malakshmi. And thank you, Kamal, for having us on the panel. I guess unlike the rest of my co-panelists today, we operate on the private side of the universe, not in the public equities or public side of the universe so much. Right. And when you kind of look at private side of alternatives, I guess you can bucket it into three large categories. So you have private equity, you have private credit, and you have real estate. So within these three buckets, we kind of operate within the real estate bucket. And within real estate, we kind of super specialize further into industrial and warehousing real estate. Right. Now, you might ask, why industrial and warehousing? The answer is that industrial and warehousing has kind of been the blue-eyed boy of institutional real estate investing for the last 5 or 6 years in general. And for sure, through this COVID and post-COVID period, where we've really seen inflection in e-commerce growth. And as most of us know, warehousing is the backbone of e-commerce fulfillment, right? So a lot of the growth which we've seen in e-commerce, both globally as well as in India, through the COVID phase and after that, has directly translated into growth for warehousing, and we're kind of the direct beneficiaries of that. With respect to what we do as a business and our product as a fund, we've now launched our second fund, which is a Category 2 AIF. Between Fund 1, which we launched in 2021, and Fund 2, which we'd launched in March last year, and we're now at the final leg of fundraising. We have raised approximately 2,500 crores. And the thesis for this fund is simple. What we do with the capital which we've raised is we use that capital to buy land. On that land, we will build large format industrial and warehousing real estate assets. which are typically pre-leased to large occupiers or tenants. Now, these are tenants which could typically be e-commerce players like an Amazon or a Flipkart or a Walmart, or they could be third-party logistics players like a Blue Dart or a DHL, right? And the idea, again, is that this is very similar to what most of us have now seen with commercial real estate, where once we've bought the land, once we've built the asset, and once we've leased it out on a long-term lease to AAA credit tenants, what you've now created as an annuity asset, which is throwing out a long-term stable rental cash flow on the back of these long-term leases, right? And once you've done that, these assets are obviously very attractive to institutional buyers and funds. And we've seen that with commercial office, where we know that today, funds like a Blackstone or a GIC or a Brookfield are the largest landlords of commercial office space in India. And they're actually now kind of moving away from what they have done in office, and they want to repeat kind of exactly the same story with warehousing. And that creates an opportunity for us to kind of sell these assets to these institutional buyers at a premium, right? So what we're effectively looking to do is to buy the land, build and lease these assets, and then once we've created a de-risked, completed and rent-yielding asset, we are able to sell these assets to institutional buyers at a premium, thereby creating a capital appreciation for our fund and for our investors. So broadly, that's sort of the opportunity, and that's our investment thesis. Of course, I'd be very happy to delve into more details as we go through the rest of this conversation.
So, Yash, right off the bat, let me ask you a couple of questions more, because once I go on to the other panelists, it's going to take a long time coming because they have a lot in common. And so first of all, what is the you are, in a sense, in this panel, definitely a super specialty fund, because you are one third of the asset class and a small part of that asset class, which is real estate, right? So how do you benchmark your returns? What is the risk reward profile of a warehouse fund? Because that's very basic to understand.
Absolutely. So Mahalakshmi, I mean, the way we kind of look at this from a risk return perspective is that the benefit of investing in an asset class like real estate, notwithstanding, a lot of the risk and volatility we have seen with, some parts of real estate, is that real estate is essentially a very sort of stable asset, which, kind of provides a fair bit of protection of capital if, the capital has been invested either in land or in, an operating or completed real estate asset. Okay. Now, while if you kind of think about what we do, it's slightly different because it kind of entails development, leasing, and kind of the risk which goes along with that. What makes warehousing particularly interesting when you compare it with other real estate asset classes is that it looks very de-risked compared to, for instance, investing in a residential development or an office project or a retail project or, pretty much any other type of real estate. And the reason is predominantly two things, right? One is that warehousing and our business is predominantly what you call build to suit, which means that once I've bought the land, I don't really start building the building till I have a back-to-back lease commitment with a tenant, right? So I sign a back-to-back lease commitment, and only then do I start committing capital to actually building the building. The other thing you need to kind of keep in mind is that warehouses aren't terribly complex to build, right? So the other large risk of any development project is basically cost and time overrun. And by default, because warehousing is just simpler, easier to build, and much quicker to complete in terms of turnaround, the risk of ending up with a meaningful cost or time overrun on a warehousing project is, by definition, quite small. Okay. So putting these two things together, what makes warehousing real estate interesting is the fact that it gives you the stability of investment into real estate, right, without necessarily having the risk which you would typically associate with a real estate project, because warehouses are relatively easy, simple, quick to build, and because these are typically pre-leased, so you're not really taking any market or sales risk, right? Now, from a returns perspective, what we kind of look at as target returns for our fund is gross IRRs of 20 to 21%. And the way I'd kind of, look at this from a risk return spectrum, if you had to compare it with equity, debt, or, what we do, is this kind of gives you returns which are debt plus, right? Where you're able to look at equity-like returns, but without necessarily, taking the risk and the underlying volatility which comes with equity investing.
Fair enough. And the is this back to the cycle? I want to understand, how long is the cycle time for warehouse, and how does that affect your fund return and the time horizon that investors should look at?
Sure. So, I mean, let's start with, what a typical development cycle for a single asset looks like, right? And then the fund is obviously a collection of, multiple assets, right? But if you look at a single warehousing asset, I mean, our sweet spot is to look at a project which could entail a land parcel of maybe 40 or 50 acres. And within this 40 or 50 acres, you'd look at building, roughly 10 or 12 lakh square feet of potential gross leasable area, right? Now that means that you will likely be building, 3, 4, 5 separate warehousing buildings or sheds, right? And each shed could be anywhere between, let's say 2 to 4 lakh square feet on an average. Typically, each of these sheds will be leased by a single client. Okay. Now, I mean, the good thing is that from a construction perspective, you're able to knock out these structures within a matter of months, right? So if I kind of had to build it all together, I could easily knock out the entire million square feet within a matter of 15 to 18 months. However, given that we kind of pace our development to meet demand, right, because we only do build to suit, the development cycle may be slightly longer because it's phased out, right? But typically for a 40, 50 acre project, million square feet, I mean, we'd budget a 2.5 to 3 year cycle from the point we've acquired the land to sort of getting the approvals, pre-leasing and developing the asset, and then exiting that asset to an institutional buyer, right? And what we're able to do within this, 2.5 or 3 year period is that we're able to kind of solve for a cash multiple of anywhere between 1.6 to 1.8 times, and which kind of, translates to our gross target IRR of, 20 to 21, 22 kind of percent. Now, the fund itself is obviously a collection of these assets. Now, the fund will acquire these assets at different points in time. So, let's say for Fund 2, which is a 2,000 crore fund, we have a commitment period of about 2.5 years. Now, let's assume the first asset I acquired today, I will deliver 3 years from now, right? And then assuming I acquired my last asset 2 years or 2.5 years from now, I would deliver it 3 years from then, right? So end to end, I mean, when we're looking at our fund, we look at it as a 6-year product. So 6 years with the customary +1 extension is kind of the tenure of Fund 2. Having said that, of course, from a practical basis, while we have a commitment window of 2.5 years, the internal target is to kind of be able to commit the fund fully within the first 12 to 18 months. And to that extent, the target is to kind of be able to complete, lease, and deliver the portfolio within 5 years with kind of 1 year buffer to account for any delays or unforeseen circumstances.
Sure. So one last question. In under a minute, essentially, what is the number of projects or number of assets that you look at in your portfolio, and therefore, is there any project execution or liquidity risk that we should factor in?
Yeah. So let me try and sort of give you context with what's already happened in Fund 1, and also tell you about what we're doing in Fund 2, right? So Fund 1, like I said, Mahalakshmi, we had raised 500 crores in 2021. That 500 crores over the last 2.5 or 3 years, we've fully deployed, right? So we're currently 90% drawn down on Fund 1. We've acquired 6 assets in Fund 1, which adds up to a portfolio of roughly 6.5 million square feet. Okay. Now, in terms of track record on developing and leasing these assets, we're kind of 2.5 years into the fund from when we started, and within that 2.5 years, we've already been able to build, lease, deliver, and complete about 50% of the portfolio, right? So 3 of these 6 assets are already completed. In fact, one of those 3 assets, we have recently concluded our first exit, where we sold one of our assets in Gurgaon to Mapletree, which, as some of you might know, is a Singapore-based real estate operator and investor. Okay. With respect to Fund 2, we are looking at possibly 8 to 10 assets, right? Because Fund 2 is obviously larger. We're looking at a corpus of 2,000 crores. But now, since we do have like a larger fund and more dry powder, we're also obviously looking to do larger deals, right? So while Fund 1, we did 6 deals with 500 crores. Fund 2, the idea is to do larger deal sizes so that we're able to look at a portfolio of 8 to 10 assets. Now, the good thing is that from a development perspective, like I explained, these assets and this business is inherently de-risked because the development cycles are quite fast. And from an exit perspective, what's interesting is that today it's really a seller's market, right? Where there is already, over the last 4 or 5 years, about $6 or $7 billion of foreign institutional capital, which has been committed towards investments in the warehousing sector in India, right? And potentially all of this capital kind of serves as takeout capital for the assets which we're building, right? So honestly, if I kind of look across the life cycle of the asset and the thesis, the exit is my lowest risk, right? Because I know anything I will build, there is enough and more capital waiting on the sidelines to buy and to provide me with that exit.
Fair enough. Okay, cool. So thank you so much for that. So quickly, one broad brush question to all the 3 of you, Nishad, Jamin, and Neil. There is a lot of excitement, and the common thread amongst all of you is that you all invest in pre-IPO stage. And this is very interesting because this is just the opposite of the feedback that one gets to hear from the public market fund managers. Whoever I talk to today say that there is great value in large cap stocks because that's the ignored segment of the market. And these we know have, there are strong companies, there are blue chips with track record of generating returns. For example, Kotak Bank, 25% over last 20 years. So many of these names that are now being treated as also ran by the market right now are out there, not gathering any attention. And all the focus has shifted. Of course, it's a much smaller segment, but there is a lot of, according to them, exuberance in the IPO market. There is very little room for money to be made in the public markets when stocks get IPO'd. There is a lot of exuberance in the SME segment. From your perspective, because you've chosen this space, what is your expectation from where we stand today? Is it commensurate with the risk that one takes with respect to IPOing companies and the SME segment? Both. Maybe we can take it one by one. We can talk about pre-IPO companies and then we can go to SMEs.
I'll take the start.
Sure.
So basically what happens is when we invest in the pre-IPO deals, usually कंपनीज का जो फेयर मार्केट वैल्यू होता है, जो उसका एक्चुअल मार्केट उसका एक्चुअल मार्केट वैल्यू है, वो लिस्टिंग होने के बाद डिमांड एंड सप्लाई पे ज्यादा कॉन्सेंट्रेट करता है फंडामेंटल से ज्यादा. सो व्हेन अ कंपनी गेट्स लिस्टेड, its price movements are more dependent on the demand and supply of that particular stock. Fundamentals obviously play a role, but demand and supply play more vital role on that particular stock. On the pre-IPO stage, it is more of the fundamental play than the demand and supply. So when we are investing in the pre-IPO stage, the demand and supply factor is not affecting the company, and we can get the exact valuation or the correct valuation which we need to invest in a company. Whereas when we invest in the listed company, we have to also consider the factor of demand and supply with subject to fundamentals. So that is why we believe that pre-IPO investments are more value bet investments than the listed investments. Secondly, we are investing in the SME sector. So these are very small companies. Um, these companies have the potential to grow at a very larger speed and aggressive than the current existing companies in that particular sector. To encash that opportunity, we have to get into investment in the pre-IPO. So once the company gets listed, we are not going to get that stock at the same price which it would have been available 1 year back on a pre-IPO basis. Third, the risk factor which comes with this kind of investment is basically eliminated with your due diligence process. So if any fund is having a good due diligence process, this factor is usually eliminated. And we have a very good investment thesis where we consider the supply chain of a particular investing company. We even take into the sentimental behavior of that company. So how are the promoters aligned? So we are not investing in startups. We are more aligned towards small enterprises who are running a 50, 100 CR manufacturing unit, doing a turnover of 100, 200 CR. So we are interested in this kind. We invest in this kind of companies.
Fair enough. So I have counters to all the 3 points, not the 3 points, actually the 2 points that you made. One is the point that, in a pre-IPO stage, fundamentals play a bigger role in determining the price of the stock compared to a public market security, which is governed by demand and supply. If I were to play devil's advocate, and what a fund manager would say to that is, private markets is controlled by a few hands, and therefore it is very easy to rig prices. And as it is, these companies are really strong with few players and with an intention to go IPO, which creates perverse incentives for mispricing. So that's the question. That's point number one. Second point is that the growth opportunity that you talk about, which of course all of us agree, and we are optimistic about India and smaller companies becoming bigger. But data shows that in the last 2 decades, if you look at the mid cap returns versus small cap stock returns versus large cap stock returns, there's hardly any difference in the stock performances. And that's because of one of the factors is also survivorship bias, which is like a lot of companies tend to die along the way and only a few survive, and therefore your returns are not as inspiring as one would like it to be. So maybe we can take Nishad to counter these questions, because these points, because you might have legitimate rebuttals to these allegations.
So, Malashmi, the challenges are always there in each and every strategy that you have. But I personally believe that whenever you try to stick to your core competence, you by default try to mitigate the challenges, because in your core competence you are the best. The moment you try to deviate from your core competence, so coming back to my core competence, so as a Pentomath group, we are the India's largest mid-market merchant banks. So what we have done is we have executed exactly 107 IPOs in last 10 years. So what we know, so the merchant banking experience does come very handy when it comes to exit, because ultimately the biggest challenge between the unlisted and listed so-called is the point of exit. The return comes later on. So that helps us. So as long as we are trying to play within our core competence, that does help. Now the entire entry strategy is keeping exit in mind. So rather than going enter,
Nishad, I would love to invest in your merchant banking company.
off
That'll
track,
be
of course,
fun, but
yes,
please go ahead.
of course, yes. So I completely agree with what Jamin Bhai has also said. So invest into the core competencies, invest into the asset-backed company. We invest into the profitable company, so that will not go, zero. We try to bet on promoters a lot. So we try to invest in a company where before our entry, promoter should have minimum 90% stake, because heavily diluted companies are technically difficult to be IPO'd. Not impossible, but slightly difficult. So if you could take care of those particular challenges, plus also what happens is that since we invest a lot into asset-backed company, a mid-market, where typically the revenue is between 200 crore and 1,000 crore. So we're eliminating the risk of startup completely. We do support a lot of artificial intelligence to the manufacturing sectors. Unfortunately, if you see the mid-size Indian manufacturing company, a 300 crore, 400 crore top line company, even a 900 crore top line company, Unfortunately, they do not have that artificial intelligence support. So if you try to support those artificial intelligence to those companies, maybe it in terms of giving them the leads, maybe in terms of giving them the proper due diligence, those companies grow a much faster way. So it's not only about the exit capabilities that we have, but we do have the capabilities to support the traditional technology, traditional assets with the help of a modern new age technology, which is the artificial intelligence, machine learning, value engineering. So these kind of extra support also we do give to our investing companies. So that helps in maybe early exits or better exits, I would say. And as long as you're trying to stick to, because India's segment, if you see, the mid-size IPOs are easily doable or comparatively easily doable. And one thing I would like to say, I'm not here to say anything about listed versus unlisted. That's a different debate. But in listed, maybe you have 6,000 units, if I'm not mistaken, maybe 1,000 are researched very actively. But if I talk about unlisted, then probably nobody knows what is that count is. Maybe 10, 100 times, 200 times. So the catchment area is very big. Nowadays, if you see on the government's policy, they are giving a lot of PLS schemes to the big boys. The big boys are definitely going to outsource that particular component manufacturing to various small scale industries. Try to tap that, because by default, big boys are going to grow. If they are going to grow, by default, their component manufacturer or outsource industries, they are also going to grow. So look at the sectors where government is giving the incentives. Those companies are too big for us. For 1,000 crore fund, even for a 500 crore fund, those companies which have big voices are really too big. But you can always help to grow their component manufacturing company, because once they grows, your balance sheet also grows. So point I'm trying to make over here is that we believe in traditional assets and we believe in developing the balance sheets. So if you try to develop the balance sheets, arithmetically, chances of failure are very many. That is the reason I call my fund as a more of a exit focused fund, wherein we also have access to a lot of network. We and lot of importance has been given on a behavioral due diligence, because ultimately the behavioral of the promoter also matters. We strictly avoid businesses which are not sustainable, which are not ethical. Also, lot of stress, a lot of importance has been given on handholding. Promoter knows his business very well, but if you try to support, never try to enter into promoter issues. He knows his business better than me. That is why he's managing that. My job is to support him from outside. So that principle we are maintaining, and keeping it a completely exit focused fund, wherein we have exit to entry funneling technically in-house, exit also, entry also, and nurturing also. As long as you try to keep the structuring in your house or within your control and you're not going outside, the tendency of failure reduces, because you're managing everything on your own. So that's the, I would like to, if I address your question properly, that's where I would like to add a points to that.
Fair enough. Neil, you want to come in?
Yeah, so if I understood your question correctly about what the large caps are offering currently compared to what the small caps are offering. So just to put things in context, different people want different things, right? If someone's old now and he's done his bit and he wants capital preservation for him, yeah, by all means he must be in large caps and not be too much involved in small caps. But there are clients who are early, and if wealth creation is something that an investor is after, he needs to clearly define what he wants. Talk to your investment advisor, understand what your goals are, and if you think that wealth creation is what you want, then small caps, in my very humble opinion, is the way to go. Any investor, a good investor, worth his for whatever it says, any investor starts out as a small cap hunter. All great investors, anybody that you know of, whether you talk about Warren Buffett, Peter Lynch, even Mr. Jhunjhunwala, he's not gone and bought Titan when it became a big company. He identified Titan very early and he held Titan for multiple years, and that's the kind of model everyone does. So if you actually ask me, all the great investors started out as small cap hunters, and they were forced out of the small cap space because their portfolio became so big they could no longer buy small caps. That's why they kind of graduated to bigger companies. Buffett over time gradually went on to bigger companies because big corpus became so big. So different people want different things, and do what you feel like. It's a free world. But if wealth creation is the motive, then you can't do it buying in my very humble opinion, a very big large cap. But yeah, small caps offer that. And if you actually go and read between the lines on what is the opportunity in India today, recently Baba Kalyani came and spoke on the defense opportunity in defense sector, and he was very clear. He said, "See, this is a multi-year opportunity. Next 25 years, defense sector will grow many-fold." That is the first thing he said. The second thing he said that private companies will lead. The government companies will not have capacities anymore to deal with what is coming. So he said private will lead, and of course the large corporates will play a part. He said, but a big part of it, a large chunk of it, will go to SME and MSME. Baba Kalyani is somebody who's more than any one of us. So he understands this far better than most of us. I mean, he's saying that there's a big opportunity in defense, and if public sector won't be able to keep up with this, private sector will do. In private sector, SME and MSME will take most of it. And he's saying it has to be IP led. So you don't want to just go and get into a defense supplier, like supplying bolts and nuts and all. I don't want that. I want something which is IP led, something software, which is highly scalable. So you need to have your own checklist, like all the other panelists are saying. Have your checklist, understand what you do, understand your core competency, and then you go and buy. And even the client must understand what he wants and his core competency. Is he looking for wealth preservation or wealth creation? So if you think you want to do wealth creation, then definitely there is no doubt in my mind it has to be small caps. And if you made your money and you want to enjoy retirement, buy Kotak Bank.
Sure. So my point of asking this question was not to focus on individual investors. I mean, of course, I take your point that whether it is Jhunjhunwala or Warren Buffett or anybody has made their riches primarily from small caps, but numbers do bear out the fact that there is hardly any difference in returns as a bucket when you look at these segments.
You can look at it otherwise
Again,
also,
time.
Maharashtra.
But and the key risk is not so much about a small company growing into a big one as much as the risk of mortality in some of these businesses. Many of them just don't survive, and that's what is the biggest risk. And that's where stems my next question to all of you. That Jamin, for example, your exit is you do pre-IPO and straight away exit on listing, or do you hold for some time, and how
So
do
it
you
depends upon the sector and the company. So usually there are two kinds of investments. There is one where we focus. We have to exit on the listing day, or we have to exit as soon as the company gets listed. Wherein we are not confident about the company on a longer run for 5 years or 7 years. And there is another strategy where we are confident about the company for 3 years or 4 years. So at that time we know that there would be a more demand for the stock on the secondary market. So we usually have a 3 year or 4 year horizon for investment. And when we don't want to stay in the company for a longer run because of any
So
reasons,
when
because
you
of the
say
sector or
3 year
anything.
or 5 year, you're saying from the time you invest to the time. So how much ahead of the IPO do you buy, and how much longer after the
So
IPO do you stay invested?
usually we have for a pre-IPO deal, we have a mandate like the company has to go for an IPO in next 18 to 24 months.
Hmm.
So depending upon that, we don't have the expertise which Nishad ji has right now for the IPOs, but still we are managing it quite well on the IPO side. That we take up the right companies who can primarily go for an IPO in next 18 to 24 months.
Okay, and then thereon you do stay invested for 1 or 2 years. Is that what you're saying?
Yes, depending upon the sector. Supposedly, we said we recently invested in a solar company. We invested 8 months back. So that company is coming for an IPO in July. But we have a plans to stay in that company for next 3 to 5 years because that sector is booming. The company is doing good.
Fair enough. Nishad?
So our strategy is, in our opinion, in any company, the person who makes the maximum money is promoter. In our language, we call it as Lalaji. Lalaji से ज़्यादा पैसा कोई कमा नहीं सकता है. So we try to, and invariably the person who makes the second highest money is, if I'm not mistaken, the anchor investor, because normally an anchor investors hold 8 to 10% of the stock. So we try to fit. We cannot earn money as equal to promoter. This is impossible. So we try to fit in between those two guys. So if you could match that, so try to come before anchor. And since we have already got 2 or 2.5 years before the anchor, so we try maximum. The main intention, the sweet spot, is to get out on the day of IPO. because that's where maximum liquidity is there. Companies trying to get IPO of nothing less than 25% as mandated. So in 25%, if you are 8-10%, your chances of exit are very high. So that's where we spot, because we already got our money returns, whatever it is. We haven't come 2 years before that. So that's our strategy. Enter 2.5 years before the IPO and get out get out means exit when the liquidity is at its highest level. So exit becomes
That
relatively
is on listing.
on listing.
On listing.
You call it
That's
on the day
good.
of listing.
Fair enough. So that's fine. Okay. Neil, just moving on to your, we will come back to this SME. I had a couple of other questions related to that, but I'll take one question on this spin-off strategy that you do, which is very exciting, because I think a lot of you mentioned value investors, a lot of value investors, right from Charlie Munger to Michael Mauboussin to a whole bunch of people have talked about spin-offs being a very stellar, consistent strategy and a safest way to make money. Tell us about the opportunity and your experience in spin-offs. What kind of spin-offs, in your experience, have worked well? Just quickly articulate your strategy.
So spin-offs, basically, this all come under the umbrella of special situations. This has been existing since decades. Buffett used to do it. He never used to call it special situation. He used to give different words for it. As you said, Charlie Munger and Joel Greenblatt is actually the guy who coined the term. And his fund did more than 50% as a CAGR over 12 years. So these guys have never had a down year doing this. So I'm trying my best to kind of, understand what they have done, learn from their mistakes, learn from my own mistakes. But if you ask me, this is I can be wrong, and no one should listen to what I say. They should do their own due diligence. But according to me, this is the most effective way to invest. In a bear market, see, you can go and buy anything, be patient, and you're doing value investing and quite effective value investing. In COVID, you could buy Bajaj Finance, you could buy Chola, and you were getting great value for your money. But what can you do that now? In this third year or fourth year of bull market, if Bajaj is trading at something like Bajaj Finance is now trading at 6-7 times of book value, it's not value investing anymore. Okay, I don't even know what kind of investing it is if you buy Bajaj Finance right now. So how do you get good quality at a throwaway valuation? So I'll give an example. A disclaimer being that we own the stock, and this is by no means. Actually, I should not talk about stocks we own. I'll give you some other example. I'll give you a hypothetical example. A company.
No, I'm sure Kamal has a proper disclaimer for that. So you
No,
please
but
go
yes,
ahead, demonstrate the stock.
It's better I talk hypothetical. So let's say there's a company, and the company is into a consumer-focused business. Let's say they sell fans, okay? And the people who buy these companies largely are consumer-focused funds, or people who are large cap funds or mid cap. You have to define what you are to your investor. You have to define to SEBI what you are. Now, when in India, companies are running conglomerate structures. So in a business which is a leading consumer company, they may do something unrelated. So investors get confused and very often disillusioned that you're earning money in this business and you're putting it over there. Rather you you do buyback or you pay me dividend, reward me. Why are you putting good money after bad, or things that I don't understand? So companies say fair enough, we'll go for a spin-off. Now, when they go for a spin-off, let's say a consumer business has a power EPC or something like that. Now, a consumer fund, by very nature of his mandate to his clients, he cannot own a power EPC business post the spin-off. So when the power EPC business will list, more often than not, the focused people or the large cap people will not want to own a small cap or something which is away from their mandate. So a lot of selling comes, an avalanche of selling comes more often than not in smaller spin-offs of a big conglomerate. And that is the opportunity. As these big funds run to exit because they are not part of their mandate anymore to own that new listed company, it opens a big opportunity. If you see charts, go back in history and see charts that after listing how stocks have plummeted. I'll give an example, something that I don't own, so that's a good example to give. Reliance did, which is India's largest company, they did a demerger of Geo Financial Services. If someone opens the chart of Geo Financial Services and see that it listed at 260 and it crashed to 200. Why did it crash to 200 is the question that you must ask, and you must understand that. Forget what the stock did later, and that's not the point. Why did Geo Financial Services list at 260 and fall to 200 within a few days? That's because people who bought Reliance probably bought Reliance not for the financial services businesses, or it got deleted from the world index and ETFs are not allowed to own something which is not in their index. So multiple factors play a role. It fell to 200 and I don't know the price. I think it's crossed 300 now. So
it was on buying circuit.
Yeah, so it's India's largest business, and India's largest business is seeing selling like that. Imagine what can happen to smaller companies which have no coverage. So according to me, in bullish markets, if someone wants to do value investing, see, different people want to do different things. But if someone wants to do value investing in bullish markets where everything is overvalued, if you ask me, the listed space is overvalued, big and bad overvalued. But if you want to do kind of proper value investing, then special situation is the only way, in my opinion. And I could be wrong. And that's a very important disclaimer. I can be wrong. So everyone must talk to their investment advisor first before listening to anybody who talks anything on TV.
If people did that level of due diligence, nobody will be investing in funds. They'll all be investing for themselves. Anyway, we'll keep that aside. But Neil beautifully articulated. So one question, what kind of opportunities do you see in with respect to special situations like this in a bullish market? In bearish markets, companies and promoters also tend to think that their companies are undervalued, and they put in a lot of effort to see how some level of unlocking can happen. In bullish markets, of course, everything's going up, so the incentive for the promoters to do something is also limited. So as a strategy in bullish markets, of course, your corpus may be small now, but as you grow bigger, is it a sustainable strategy?
No. The very clear answer is no. It's a very niche strategy. You cannot manage big money doing this. That's the reason we launched the AIF, to increase our horizon and increase our universe. I realized that, these IPOs that are coming is kind of in the same thought process, that, you're getting a good quality business at a very throwaway valuation, especially in the SME segment. And one same thing like special situation. No one focuses on special situation. If you talk about the big funds, they don't want to look at it. Same with the SMEs. No one wants to look at it. They think it's all fraud and it's not genuine. And they may have a point. A lot of companies are not good. But if you do proper due diligence in the SME segment, for example, you kind of are able to put, you end up getting decent businesses who are actually genuine, who are in actual genuine need of money, and they come at very good valuations. So if you ask me, special situation is one thing, and then that's the reason we started this AIF, so that the similar kind of thought process can be implemented on a larger universe. But coming back to your original question, I think special situation is a very limited way of investing. Sure. In a bear market, very easy. In bull markets, it becomes the air becomes lesser and lesser, right. And the AUM increases become very difficult.
Correct. All right. So just a couple of questions and then we wrap up. So going back to Nishant and Jaimin, on the SME space, I mean, two things. Of course, this has been stocks in the space have been sizzling. It's attracted a lot of right and wrong attention. The regulators are worried. The investors are excited. So two things. When you think about the SME opportunity and investing, especially you, Jaimin, because you stay invested, you're not selling everything on day one of listing. How do you deal with the liquidity risk? Because that is a risk I see even fund managers are worried about with respect to small cap funds. For example, Nippon, of course, the corpus is really big, but one can't imagine a fund manager invested in, nearly 280, 290 stocks. So obviously, liquidity risk is foremost amongst most managers. So how do you think about liquidity
So
risk,
basically,
and how do you deal
Mahalakshmi,
with it?
what is happening with big funds is that they already are having big corpuses कि वो SME में नहीं invest कर सकते. मतलब ऐसे कुछ fund
नहीं, वो
houses हैं.
अपने हिसाब से अपने को लिक्विडिटी देख रहे हैं. आई एम सेइंग इन योर स्पेस विद योर कॉर्पस, how do you deal with liquidity risk present
Exactly.
in the SME segment?
Yes, yes. I'm coming to them. So that's why they are not looking at this SME space. As a small fund, we are looking for SME and small funds. के लिए SME is the right corner right now because this will grow companies. On the liquidity part, see, SME exchange was started in 2012. And right now we are sitting in 2024. So it has been 12 years to SME exchange. So the myth that SME exchange is not having liquidity was before 2022. उसके पहले अगर कोई कहता कि एसएमई में लिक्विडिटी नहीं है, आई वुड हैव एक्सेप्टेड इट एंड हमने शायद एसएमई में इन्वेस्ट नहीं किया होता. बट इन टुडेज मार्केट इट इज नॉट द सिनेरियो. 2022 के बाद एसएमई एक्सचेंज की लिक्विडिटी हैज ग्रोन टू 2x 3x 4x. ये उस कंटेक्स्ट में ग्रो हुई है एसएमई की लिक्विडिटी. और हम एक बहुत बेसिक सा एनालिसिस कर सकते हैं. एक एसएमई का आईपीओ आता है, 2 आईपीओ अभी खुले थे, कल ही बंद हुए. दोनों का टोटल सब्सक्रिप्शन था 20,000 करोड़ का, 20,000 करोड़ का टोटल सब्सक्रिप्शन. इफ द प्राइमरी मार्केट इज हैविंग अ लिक्विडिटी ऑफ 20,000 करोड़, उसका 10% और 15% लिक्विडिटी भी सेकेंडरी मार्केट के अंदर आता है. स्टिल इट इज अ वेरी गुड लिक्विडिटी फॉर एसएमई एक्सचेंज. So in this context, from today, from last 1 year, we don't see any liquidity problem. We have done 12 anchor investments in last 7 months, and we have exited about 4 anchor investments as and when the lock-in has been completed, and we have very swiftly exited the stocks without any liquidity issue.
Fair enough. Nishant, one last question to you, which is, one of the reasons this SME space has a lot of critiques is because the compliance requirements are the standards for compliance are very low. Even as simple as having a quarterly disclosure of results, even that is not that. You only do it twice a year. Second is there is no regulatory supervision directly by SEBI. It is governed by exchanges which are, loosely done. So again, what is your view, and what is the risk? Are investors legitimate in raising these concerns, and how do you deal with it?
So Mahalakshmi, the risk may be Jamin can tell you better, but forcing your questions, that is the reason we have moved towards the main board. Because if you see the kind of companies that we have invested, the average revenue would be in the range of 800 crore, and average gross block of the company would be in the range of 400 crores, wherein we are investing 40 crore. So 400 crore company में आप 40 crore डाल रहे हो तो at least gross block से तो आपका asset पे protect हो जाएगा. So to create the more liquidity, we have become more of a main board players now. So this year also, whatever IPOs we got as a merchant banker, even the merchant banking division, they have got more of the main board IPOs. And I'm not here to say anything against SME. That's not my point. But to have the more liquidity, let me put it in another way. To have the more liquidity, we have become the more of a main board player. And the kind of assets we invest, they are also of the main board, where of course the transparency is more, the liquidity is more. You try to get more institutional investors also, though institutional investors do come nowadays on SME also. I'm not saying no, but the probability of hitting a good institutional investors, because if you try to get a good institutional investor than anchor, the probability of increasing your IPO or oversubscribing your IPOs tends to increase. So looking at these points, my concentration is more onto the main board IPOs nowadays. In terms of concentration, I would say 85% would be for 85 to 90 would be main board, and 15 to 10% would be SME. That would,
Sure.
from my point of view.
Sure. So one final question to all of you. In under 30 minutes, under 30 seconds, just articulate why should one be considering investing in alternates like your fund, and what is the biggest risk that they should keep in mind while stepping into your fund? Nishant, you can go ahead.
Am I allowed to make a marketing statement?
You can. I mean, how do you convince investors? I mean, this is the best thing, but obviously there is a disclaimer because you're also supposed to talk about your risk.
आप
big risk.
IPO लगाते हो, आपको लगता नहीं है. That is a well-known fact. So राशन की लाइन में क्यों लगाते हो? जब हम बच्चन सब की तरफ बोलते हैं हम जहाँ खड़े हो तो लाइन वहीं से चालू होती है. So we are like giving you a confirmed seat because we come before anchor. So the confirmed seat is there on the day of IPO. So if you want a confirmed seat, come with us with a fair amount of exit capabilities that we have possessing. So exit is certain. Nobody in the world can guarantee you about the returns. But yes, exits would always be there. So if you want to play into the exit market, mid pre-IPO market tendency is that the history says that you tend to make more money, provided Malakshmi, you know how to exit. Otherwise, sorry to say, a bold statement, your share certificate and tissue paper has one and the same value. Very jokingly we say. So
Yeah. So is
that
that
is,
also the biggest risk that you will want investors of?
of course, if you're investing into the unlisted space, you should look at the fund manager's capability to exit. That is the big factors. That is the reason we are an exit focused fund.
Fair enough. Jamie?
So I'll say we started this Chanakya Opportunities Fund 7 months back, and we have delivered a return of about 72% in this 7 months. So our IRR is coming at about 120%. Out of the 72%, we have already booked a profit of about 40%. So 40% is a realized gain. It is not on the pictures or on the screen. We have a cash position of 40% return. So this is why you should, this our past performances show this. The second thing which we have done best is we have given a complete transparent structure in alternatives investment fund system, whereas there's no AIF giving a transparent live NAV. We give daily live NAV, we give daily live cash positions. So our structure is completely transparent. Third, the risk
What
is
is the biggest? No, third, you're not allowed. Now only risk. One.
so on risk. Third, I was coming to risk only. So the risk is I could end up on a returns of 20 to 25%. That is the risk.
Fair enough. So past performance is no indicator of future returns. Fair enough. Neil?
Yeah, so I've managed both funds. So I've done capital market by the PMS, and we now do AIF also. So we're doing both the things. So I think I have an idea as to, having a fairly successful PMS, we still moved on to the AIF. Was that you can do more things in the AIF, as Nishad ji said, that not getting IPO allocation is a big problem statement. And if someone can solve that for you, then that's a good place to begin. So yes, alternatives gives a much bigger advantage compared to a normal structure, which is a retail structure or a HNI structure or even a PMS structure. The alternative, the AIF, is a much better way of investing. Yeah, in my personal opinion, I have both PMS and AIF, so I'm neutral. So AIF is much better. Now, if you say risk, any equity investing is high risk. Okay, we should have no two ways about it. Markets can fall off a cliff, and we can also fall. No matter what your strategy is, your fund will fall. And some pre-IPO, if you do, you could be stuck 5, 6, 7, 8 years without getting any returns. So we also do pre-IPO, and I'm very mindful of that fact. So we have to understand risk. And before we understand risk, as an investor, it's very important to understand what you want. So coming back to what I said earlier, if you want to preserve capital, you're better off in a mutual fund kind of structure. It's totally listed. But if you want to create wealth and you want to take the risk, then AIFs could be a way to go.
Fair enough. Unless we have lost Yash. Yash, you want to step in? I'm sorry for the long wait.
Yeah, no worries. So clearly, I think this discussion was dominated by the public equities members of the panel, but maybe I'll chip in to conclude. But so Mahalakshmi, I think, look, the basis of alternatives is basically to say that, okay, listen, there isn't a free lunch, right? So alternatives by definition will come with more risk, but they also come with a higher likelihood of being able to create alpha, especially if you pick the right manager, right? So beyond the point, I mean, while the rest of the investing universe, I think, is more and more commoditized, where the chance of being able to create an alpha, even if you're a great manager, I think is lesser and lesser. Alternatives kind of presents the opposite of that, right? Where yes, there may be lack of liquidity sometimes, yes, there may be risk, but if you are looking for alpha, and if you're able to find the right manager, right, and I think you have a couple of the right managers on this panel today, alternatives is probably a good bet for you. Specifically, from from the perspective of what we do in real estate, I think real estate is also a great way of being able to pick investments which are non-correlated to market volatility. So what I'm hearing from a lot of my co-panelists today is that of course being a value investor in a bear market is easy, and you can find great value buys. But what do you do in a bull market? Life obviously becomes harder. It's that much harder to find the right stock. So maybe a good strategy from an investor's portfolio allocation perspective is to look at something which is non-correlated to market volatility. And real estate, by the way, globally is one of those asset classes, right, where you are able to invest at scale into an asset class which is to a large extent non-correlated with the market, and which, if you look at any large institutional investor today, between 10 to 15% of his portfolio is actually allocated to real estate. Blackstone, interestingly, as a manager, out of their now $1 trillion AUM, which is a fairly ridiculous number, has about $400 billion in real estate, right? So I think that is the strength and attractiveness of real estate as an asset class.
Sure. So thank you so much, gentlemen, Nishad, Jamin, Neil, and Yash. Thank you so much. It was a really enlightening discussion for me to know your perspectives. Thank you so much. And thank you, Kamal
Thank you
and
so much.
Charming and PMS AIF for this wonderful opportunity. And I hope all of you enjoyed. Over to you, Akriti.